Taxation and Assessment, Chapter 16, Essential Matters of Learning the Chapter Property Tax, Income Tax, Real Estate, discussed in Chapter Property Tax called ad varium tax, meaning that applied against the value of the property, general, local government, and units of the assessed property tax against value of the real estate of the governments usually include city, county, school districts, some property owners, users, exempt property tax, notability, government property facilities used for the original's purchase, some of the property's owners should be allowed with a discount, notability, homestead exemption, owner, occupant, other exemptions must provide those other certain ages, military veteran, people that have low income tax to deem district reappraisal of real estate periodically market value that may change the assessment of the sale of the market of general revaluation. Reevaluation tax restrictions provide method of the owners to apply with the easement. Ad varium taxes on play with it become a lien for the property to be sold if dissatisfied with the lien. Tax liens have priority over the other liens, even liens predated with the tax lien. Mills or property taxes are generally expressed in mills. Mills are thousands of a dollar. 10 mills is 10. There are 10 mills and a penny. The tax rate of 20 mills is the annual tax of 2% on the dollar. Value of 2% of the value with the $2,000 for one $10,000 property. Some jurisdiction tax rate with a fraction market value of 40%. In this case, for $100,000 market value property is standard assets at $40,000. The tax rate is applied with the assessment amount. Income taxes are applied with the federal government. Most states, homeowners itemize the tax deductions rather than standard deduction. May deduct the real estate taxes, mortgages, interest purchase up to homes plus of $100,000 of debt. Discount points of the purchase home may be tax deductible if certain occupancy and ownership holding periods are met. At $500,000 gain over the house sale of the house, a married couple is not taxed. Up to $250,000 of the gain, a married individual is not taxed. Tax based original cost plus capital improvement adjustment tax base and provide the subtracting depreciation deduction claim by the income tax purpose adjusted the tax base starting point determination gain loss of sale of real estate for income property rental income included with the gross income ordinary reasonable expense for the deducted determining an annual taxable income loss or generally interest expense the tax double addition with the tax depreciation expenses section 1031 portion of the internal revenue provides opportunity with the deferred tax for the gain of sales properties viewed with the trade of the business held as an investment and replacement property, which also must be with the trade or business. Holder's investment must be identified within 45 days close of the 180 days sale of the old property and light property. If such the cash received the exchange is called the boot. The tax must be paid to the extent of the boot received no more than the gain. Most real estate brokers arrange salesperson independent contractors rather than employees. Independent contractor salesperson set their own work. Sales pay their own income taxes, sale and Social Security, self-employment taxes apply. Economists classify taxes regressive, progressive, or proportional. Regressive taxes one which people have low income pay with a higher proportion of the income than most affluent people. Sales tax on food regressive because it requires those of low income taxes to pay the same tax of a loaf of bread as a wealthy person pays. Progressive taxes one those with a higher income a higher proportion of the income tax of the generally income tax. Progressive structure proportional tax is one which the tax burden is applied to high income low income taxpayers. Real estate is because the valuable is hard to hide. It's subject to the tax nearly all human history. Consequently, easy officials assess tax on the real estate with the property tax ad varium tax is based on the value of the being taxed and the effect of the tax bill. Large valuable property should be more than a bill and one small relatively low valued one. Property tax usually with a major source of the income city with the county government and some of them may be just with the cover of the real estate but provides bulk tax for the collective that also benefit the greater many services the local governments pay for the property taxes collect the most important fire protection accrues the almost exclusive of the real estate with the pole. These protection provisions and maintenance of local street roads also provide a obvious benefit to nearly local provided public amenities such as schools, parks, make kinds of the real estate more valuable. The control of the real estate development, the zoning of the building codes also tend to preserve value of the existing real estate, improving the code of the provision planning for the in addition local courthouses store with the record of the necessary with the documentation of the title of the real estate. Tax assessment of the real estate with the taxation is relatively straightforward. Some of the elements should be studied with carefully before because tax is based on the value of the right real estate. Some of the methods exist to determine the value of the parcel of the real estate with the tax jurisdiction. For the purpose of the local government usually have the tax assessors offer although the offer goes different name function offer the valuation upon parcel of the tax property of the jurisdiction. Sometimes it's done with the actual appraising of each of the property, but the method is very expensive. Experts accept for the most valuable properties. Most often the assessment is arrived at the simpler means frequently indication of the value made of the property sold will be to determine the sales price, which is assumed with a very close to the true value of the state of the documentary stamp of the deed transfer taxes appraisal. Sales price often deduced from the value of the stamp is affixed to the deed from the amount of the transfer tax paid. Often all the assessments adjusted for the specific formula each year of the tax and take into account with the inflation and the other reason the overall value. Change in building permanents serve as a pinpoint the new constructed addition of the existing building's aerial photography accomplished for the same object. For the often single property will be more than one tax jurisdiction. Most commonly, property have the particular county as well as specific city and town, and each may level the taxes. Many area the independent school districts as well. Furthermore, they can be multiplicity of other kinds of taxing district, depending upon which state and local laws will allow. Provide usually, however, the single assessing agency will provide valuation for all taxing jurisdictions that affect the given property. This is doing because of the assessment of the expenses process duplication of the effort thereby avoided. Every jurisdiction provides some means whereby the property owner can appeal the assessment that considered unjust. The exact method of the appeal varies considerably across the country. You should find out how it is done in your state. Exemption from property tax. Not all real estate is subject to real property tax. Some of it is exempt. Exactly what is exempt, what does not matter to decide both the state and local laws. Some of the kind of the property, however, that exempt almost everywhere. Primary among these property owned by government exemptions. See, to make sense, it would be peculiar for the government to pay taxes to itself. Of course, there are several governments that allow the conceivable that could pay taxes to one another. They don't. Therefore, all government-owned property, no matter what government owns, except for the exempt from property tax in some areas, which large proportion of properties government owns. The situation can work a hardship local taxpayer owners' property, especially with the government-owned property, receive many services paid for the local tax. For example, the problems areas such as Washington, D.C., many small city towns provide school or other services large in government, usually military establishments. In such cases, the benefit branch of government often will provide some of the direct grant of the money to the effective local government to make up the unpaid property tax. Some of the privately owned property may also be exempt from tax. Most areas exempt certain kinds of lands. You seem to provide other benefits to the community, making them desire when exempt of the property tax. They usually include churches, nonprofit, private schools, some of the other charitable organizations. Some localities, all property owned with such organizations exempted for the tax. However, the current trend is toward granting exemption only to property those that actually used by organization for basic purposes. In such area, the church building used for religious purposes would be exempt, but an apartment project owned by a church would not be, even if all the profits went to the church. Payment of taxes. Past due properties automatically become lien of property is so affected if the taxes remain unpaid. The tax government eventually can foreclose half of the property sold in order to pay the tax. This is a tax lien of the property over all the liens, including mortgage, even the ones that are being entered for the records of the tax liens. Normally, property owner has a considerable period of time between the time of the taxes actually levied and the day of the payment is due. Specifically, schedule file varies of the state, the state, sometimes even among localities within the state. Of the matter of fact, with the property owner who land fails more in the one tasking district may find the various districts differing in collection schedules. However, often spread for the chore of the remembering the taxes due because of them as mortgager requires to make a supplemental payment to the escrow account, which are each monthly principal and interest payment. The monthly amounts up to create a fund from which the lender pays taxes, usually insurance when they are due. Generally, with the lender contractually responsible for the borrower paying the taxes out of these funds. If this mistake, the amended penalty is required to the late payment, the lender can be held liable to the borrower. Alright, calculation of property tax. Calculation of property tax, 3 figures necessary to appraise valuation of the property with the assessment ratio and the tax rate. The assessment ratio is applied with the valuation obtained with the assessed value, with the tax rate with applied with the assessed value, with the order to find the tax due and effective tax rate with a certain proportion of 17.66% of the assessed valuation, or $76.60 over the 1,000 valuation, and 76.6 mils per dollar valuation. These represent the same tax values rate expressed in the 3 different ways. To determine the tax rate, usually easy to determine the rate with a percentage figure it can easily apply to assessed valuation through the simple arithmetic procedure. Rarely, however, the tax rate expressed with the percentage instead is usually given the millage rate. With the millage rate, specifically how many mills must be paid to each over the dollar assessed valuation. Mills are 1/10 of a cent. Therefore, the 1,000 mills is a dollar. The millage rate then shows how many thousands of the assessed valuation must be paid in taxes. Millage rates are easy to convert with a percentage with a measure of the hundreds of the toe of the chain with the millage rate with a percentage rate with the decimal point is moved with 1 place to the left. The same with dividing by tens of there are 10,000 in each 100th. Consequently, a millage is 77.6 is the same as 7.776%. Sometimes millage is expressed in so many dollars per thousand as assessed valuation. In either case, for the figure with 1,000, so the numerical value is 77.6 mils net per dollar is the same as $77.60 per $1,000. Once the tax rate is expressed percent, the next step is to determine the assessed valuation to which of the Providence home state the locality assessed valuation, same as the market value of property is estimated by the tax assessment. In other ways, however, the only market part of the market value of the subject of the tax, sometime of the taxable amount is fixed state by the other localities, local government to determine the taxable portion estimated value. Other figures so arrived will be altered even further. Many states have homestead exemption, which exempts a certain amount of the assessed valuation from taxation. Often older homes get some special exemptions due to low-income homeowners in a few areas. Once the exemptions are determined, they are subtractively assessed the valuation to arrive at the net figure upon the taxes based. However, the further element of the computation to enter the picture. Many properties subject to tax more than one jurisdiction. Method of calculating assessed valuation exemptions may be allowed and can be vary among. When assessed valuation subject to tax may determine the tax rate is applied to determine the tax to be paid. For example, assume the property has a tax assessed value of the $100,000 millage rate at 77.6 or 7.7%. So you get $7,760. The effective rate is 1% of the or 3% property value. Income tax. Income tax is numerous and complex. Some of the highlights are affecting real estate indicated below. The distinguish between the effect for the personal residence and those that apply to income property. Personal residence income taxation. Import maintain permanent records concerning acquisition personal residence of the initial cost of the base of the determining gain or loss that can stay with the owner through sales and purchase of subsequent homes. Home acquisition deduction. Acquisition of home give the right of the tax deduction discount points of the mortgage loan with the right of the discount points for the interest. Not for services customary for the area to be taken with the interest deduction. Since 1994, Internal Revenue Service has allowed deduction discount points of the buyer of the points have been paid by the seller post incurred of the refinancing personal residence are treated differently with the original debt. Point of refinancing must be organized, spread out equally each period of life of the loan. Ownership of the tax deduction. Two principles of tax deduction allowed by the homeowner include condominium, comparative apartment owner, a property tax, and interest and expense. You may deduct the interest upon the two residency with your costs plus over the additional $100,000 of the debt. The maximum federal income tax rate, writing at approximately 40% of the tax, saving and reducing large home ownership expenses up to the percentage. Home sale, a married couple may exclude a $500,000 gain of sale of the principal residence, and a single individual may exclude up to $250,000 of gain. Therefore, there is a limit on the frequency of the exclusion requirements of the principal residency. Income tax of the income property. Purchase of the income produced the real estate ordinarily does not generate immediate income tax deductions. Buyers should, however, indicate how much was paid for the land and how much real estate improvement to how much personal property exempt from the land but not depreciable. Depreciable real estate improvement of the personal property generate tax deductions. Operation of the income property. Rental income will include the business income and Schedule C. The tax return expense for the business operation tax deductible. This includes but not only the interest, value, variable taxes, maintenance, repairs, management, interest, all other reasonable and necessary expenses to operate the property. Depreciation non-cost expense for the service that reduce the tax income. Pre-cover the depreciation provide the deduction without a cash payment. They consider the very favorable owners under present tax law of the parent. Apartment owners may depreciate the property, not land, over 27.5-year term. Owners of the other property types, such as other buildings, warehouse, shopping centers, and so on, must use the 39 years depreciable life of depreciation deducts for reduced tax basis of the property, which could cause a taxable gain up upon resale. Resale adjust the tax base of the subtract with the resale price of the real estate with the derive of the taxable gain and the adjustable tax base for the original cost loss of depreciation plus capital improvements. This gain is generally taxable capital gain. However, a certain type of depreciation tax deduction may be the taxable ordinary income upon sale. Exchange. Under Section 103(1) of the Internal Revenue Code, opportunities postpone defer the tax gain with one of the most indefinite potential replacement property within 45 days of the sale of the date previously owned property closed within 180 days of sale of the old new property must be held with the trade business held then as an estimate of the realized gain will the taxable extent of the seller received the unlike property including cash which is called the boot. Other taxation issue the economic impact taxation. Economics clearly taxes relationship to impact the ability to pay the taxes regressive when those of the law and income pay higher portion of that means than others. For example, the poor people pay same tax of the loaf of the bread as the wealthy. Tax is proportional when the tax is proportional to the taxpayer means add value and property tax is proportional because of the people buying houses according to affordability. Tax is progressive when the wealthy pay more. Income tax is increased with the higher income. Income tax is progressive. Independent contractor versus versus employee. Independent contractor works him or herself with a part of the self-employment taxes paid and its estimated income tax. By contrast, employee pays Social Security tax from his or her paycheck, but the employer deducts income tax, Social Security tax, other withholdings. Employer must also contribute to Social Security, other programs. More real estate brokers prefer to treat salespersons independent contractors. They may provide the donor and exercise control, such as the where, what houses, hours person works, ownership, tools, supplies, person, vehicles, computer payments for due. Checklist of your state's locality property taxes. And that's chapter 16. Chapter 17, real estate investment.